Welcome everyone, I am Sensei Kevlar. In the past dojos, we have been talking about ways to maximize our opportunities, maximize our strategies. The ways that we have been working on that so far is we have been building up our knowledge of the markets through technical analysis and creating strategies that make us profitable no matter what direction the market goes. So we schedule our allocation for the entire downside all the way down to zero, creating our opportunities all the way down. And then what we do is we use additional indicators like the Williams and the RSI, the Williams bottom finder and the RSI, and whatever other indicators that you go over to Investopedia and investigate what it is they're doing. This is really critical, okay? Come in here, find an indicator that you really like, take a look at the awesome oscillator and see what it's doing and seeing what it's telling you. See that when this happens right here, see if it goes up, right? See if this is a really strong signal in this market. Turns out we definitely had more room to go when this thing really hits the floor here, especially on the RSI. But look, this could be a good signal in the future, especially when we see this coming down. We see this, maybe we need to build a more sophisticated strategy than just saying, these oscillators, this oscillator looks down, the RSI looks down, the MACD is signaling green, okay? Maybe we need to build a better set of strategies, one that's more sophisticated. So let's look at this RSI again, and we notice about the RSI that in this market, for the most part, where we're making our money against these support and resistance lines, especially in a nice straddle on this market, what we're really doing, is allocating down here in a straddle, as opposed to allocating one position here in a layer, because we want to layer in versus we're straddling this market all the way across. What we want to do is we want to come up here and we want to say, well, when the RSI went above 70 here, that's the 70 line right there. When it went above 70, those were the times when we really thought we could, take our profits and get out. But more importantly, when it went to 70, but then it went back down, and then this went sideways, that's the opportunity that we really could have created for ourselves. Because if you see, let's take a real closer look at this right here. At this motion right here, okay? What happened was the RSI signaled it went above 70 here in this part of the motion. Let's make this even bigger. Between the 12th and the 19th, there we go. Let's get some more time frames in here. Between the 12th and the 16th, the RSI went above 70. At that time, we definitely hit our resistance line. We definitely hit our support, our resistance, and then later, what happened? First, we hit above 70. Then, later, we hit a new resistance. Except the new resistance wasn't nearly as high up anymore. What is our trend line trying to tell us here? Our trend line is telling us that here, we've got a lot of market motion. But here, this motion is not nearly as significant. This trend is not as strong as this trend. This trend is bringing our RSI back into the norm. And as soon as the RSI comes crashing back down, that's when the RSI truly signaled. Okay? So, what we're looking for is building our strategy. We're trying to say RSI above 70 arms the strategy. RSI back below 70 executes this signal. But this signal hasn't occurred yet. This one right here. This signal being, let's go up against the resistance point. So if this is 1-4, we went above and then below. This is 1-4. If this is, we go up and we touch it, here it is. Here's our moment. Here's our signal to sell. This is our moment to get our best opportunity in the whole market. Look at how we set that up for ourselves. First we armed, then we triggered. First we armed, then we triggered. Okay? We said we're not ready to sell because we're not at the resistance point, and we think we can still go up to the resistance point because we're still in an upward motion and we're above 50. But we definitely have armed the signal and we're ready to start taking profits. This is our moment to be taking profits because look, here, this motion was strong. But here, this motion right here, these motions right here, this motion right here, it's not really breaking a new trend. It's all sort of moving within this trend. It's a sideways market. It's not really a true upward trend. Barely got up to here before crashing back down. By building this signal right here, what we're doing is we're building out and maximizing our opportunities. Now in the last dojo, what we looked at was we looked at how to schedule this opportunity by maximizing it against a time frame. We can do this in our buying. We can schedule our buying against a time frame. We can schedule our selling against a time frame. We can schedule our selling against a buying and against a time frame only when this signals. And how does it signal? It signals first by going above 70 and then below 70. How does this signal? Well, it signals by going way up and then coming back down again above, they don't have numbers on this thing. Kind of a useless oscillator here. Find another indicator, right? One that tells you what you're looking at, one that tells you what you're looking for. Bring in the MACD. The MACD is a cool one. Okay, the MACD is two RSIs. A long one and a short one, a long period and a short period, and they're exponentially weighted. So the longer back you go, the less importance they have. The signal has. Okay, so the short one only includes 12 time frames, and the long one includes 26 time frames into the past. Okay, so if we were here, if this was, let's say we're here in the future. Here in the present, this is the past, and we don't know the future. Okay? What are we looking at here? Well, what we can say is that recently the RSI went above 70, then it went below 30. Let's bring in that MACD so we can see it a little bit better. Remember, the MACD is like an RSI, but it's got a smoothing weighted average on it, so it smooths things out. The blue line here, I'm just going to make this a little bit bigger so we can see it a little bit better. The blue line here is the fast 12 candles back. So I would count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And this is how many candles I would be including in my RSI calculation with a weighted exponential decay on it to smooth that out as further back the values become less and less meaningful in my series. Okay, the long one has 26, so I would start here and I would count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26 candles back. Much more information comes into my weighted moving average, which then decays. I'm talking about the MACD right now, guys. This is the first time. The weighted moving average decays, and what we're doing is we're sorry about that. What we're doing is we're trying to measure a longer period of time against a shorter period of time. We're trying to say, let's look at the fast moving average, the blue line, and let's compare it to the orange moving average, the slow line. We'll compare this, and what we're looking for is we're looking for the fast moving average to cross above or below the slow moving average. So what we're saying is that in the same way that this trend line is telling us when the market has gone up rapidly or when the market has gone down rapidly on average, this is telling us when the fast trend has changed against the slow trend. Okay? Here, on the other side, we see exactly the opposite. The fast trend responds faster than the fast trend, than the slow trend, and then the slow trend comes in and moves with it. Now, why 12 or 26 candles? Well, I don't know. I don't know what's right for this market. I don't know what's going to signal the best for you. I don't know what's going to tell you the best information. You can come in here and modify it. You can come in here and, click this button right here. Click your input, and I believe we had a suggestion for 13 to 34, which is a perfectly valid analysis. See how it slightly modifies the analysis is now this is moving much slower, and this is moving a little bit slower, but not a lot, right? Finally, what we're looking at here, this red histogram it's called. The point of the histogram is to measure the divergence between these two, so the amount of difference. The wiki that's being spoken about is probably Investopedia. Investopedia is a fantastic resource for looking up more information about these things. As I was saying, the divergence is the amount of difference between these two things. So as the fast trend moves ahead of the slow trend, moves faster than that, what happens is that the fast trend separates. It diverges in its trend. Accordingly, the slow trend responds, but then the fast trend takes over quicker. And here we get the MACD crossing, where two lines cross over each other, and it comes up here and it crosses again on the fast trend when we get this nice bump up right here. See right here we get the nice fast trend going up over the slow trend. But really, let's look at what this MACD is telling us. This MACD is once again telling us that our slow trend is downward. Our long-term trend is downward. If we're here in the market and we're seeing a long-term downward trend, we just got another crossing above and below. We couldn't get that momentum above. We'll look at this moment right here, right? The crossing above, but look at your RSI. Look at where you are. Look at the amount of recent divergence hasn't really come down against this divergence over here where things diverged. Okay, then what happens is the slow and the fast trend move into correlation with each other. They become the same line. That's convergence, or they converge. Okay, and so this is why this signal is called the moving average convergence divergence, is you're measuring those three things: the moving average, the convergence, and the divergence. And what you're looking for is you're looking for that crossing. You're looking for the convergence of the crossing and the divergence of the crossing. Okay? So in this way, these automated indicators are signaling to you. That's the point. Let's break it down. You have an indicator. The indicator is the RSI. You have a signal. The signal is that it goes above 70 and then back to 50. The indicator is the MACD. The signal is the MACD crosses. The MACD fast trend crosses the slow trend above and then below. And the convergence and the divergence turns into convergence at that time. That's the signal. The strategy is that when the RSI goes above 70 and then back to 50, when the MACD goes crosses above and then below, when we hit our resistance, the strategy is we will sell our positions, schedule our distribution here. Okay? And the plan is how much are we going to sell? How much are we going to buy? One more time. Indicator. Indicators RSI, MACD, resistance, support. Signal. Signal is touching resistance, touching support. RSI above 70, hitting 50. MACD crossing, above and below. Divergence, convergence. Strategy. Touching resistance and support. MACD or RSI crossing, going above 70, coming down to 50. MACD crossing, RSI going above 70, down to 50. MACD crossing, divergence turning into convergence. Sell our positions. Plan. Do all of these things together with this amount of money. This is how much money we're going to spend going up. This is how much money we're going to spend going down. Now, let's talk about what happens when you get sick of doing this. Because, frankly, this is, as somebody pointed out, a lot of math, and it's a lot of work. It's a lot of stuff to do. It's a lot of things to focus on and keep in your mind at the same time. So, let's go back to basics. Let's write it all down, right? If we are touching resistance and the RSI went above 70 and returned to 50, and the MACD divergence turned into convergence, which signals a crossing, right, as we know. Sorry, somebody was asking one more time what a convergence is. All right, I'll do it again. When these two things are separating, this is divergence. They are diverging from each other. They're moving away. The red histogram is measuring the divergence. These lines right here. Convergence is the opposite of that. When they converge together, so they cross over each other. They say this is divergence right here. We see them separating, and then they come back together. Convergence. Blue line crosses over the yellow line, orange line, whatever it is. Let me get rid of this red line right here so you don't have to get confused by that thing. Okay, we see the blue line moves away from the orange line, then it crosses right there. The blue line crosses first above, back here, then below, right here. Divergence, convergence. Measuring divergence, measuring convergence. Going back to the strategy, which I seem to have lost. There it is. If we are touching resistance and the RSI went above 70 and returned to 50, and the MACD divergence turned into convergence, then we sell our allocated, we sell our distribution amount. Okay. Yes, absolutely. When histogram moving towards 0, that's convergence. That's when the two lines are going to cross over each other. Because at that time, all of the separation has been eliminated. They are converging. And you can see on the histogram right here that this is divergence occurring. This is convergence occurring. You can see it up here, but it's easier to see in the histogram. If you just look at your histogram, you can see that divergence was occurring on the upside. You can see that divergence was occurring on the downside. And you can see on the histogram right here where the crossing occurred. You can see in the red line and the blue line where they touch, and that's convergence. Okay. Going back to our strategy, here's our strategy. Now we're going to make a plan. We're going to start with one position. We're going to double up. We're going to triple up. Okay, that's our plan. On the reverse side of that, right? What is this? What does this look like? If we are touching not resistance, support. If the RSI went below 30 and returned to 50, and the MACD divergence turned into convergence on the downside, on the upside rather, then we buy our allocation amount. Okay, but it's better than that, right? Then we schedule our allocation. Okay, we schedule our distribution. Okay, and what that means is that we come here and we say over this time frame we're going to do this much selling, and over this time frame we're going to do this much buying. We schedule it, push it out over some period of time. Okay, so what are we talking about here? We're talking about a plan that we can automate. If this is what we want to do, then this is what we tell our automation to do. We make a plan on paper and we say, okay, this is the plan, and I'm going to do this much, and I'm going to use this strategy, and I'm going to include these signals in the strategy, and I'm going to use these indicators to make these signals. Work it backwards. I'm going to use these indicators to generate these signals, which is going to inform this strategy, which I am then going to execute using this plan. This is the automation mindset. If we are here, we do this. If we are here, we do this. Now, let's write the code. If and if resistance is true, and sorry, this is and. Put this, make this and. 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 No, that's it. There's the automation mindset right there. All we did was we took our strategy and we transformed it into something that we can tell the computer what to do for us. Okay? Now what we need to do is break down each of these. What does it mean to be at resistance? Well, let's take a look. In this case, at resistance means okay. Now we have the first part of our strategy programmed. Okay, what does it mean to be at resistance? Well, it means for the price to be above 3,500. Okay, above 3,500. Hey, we're at resistance. Congratulations, it's time to sell. Okay, what's next? The RSI was, okay, what's RSI was? So what we want to do is we want to say, was the RSI above 70 in the last X amount of time frames, let's say, right? Let's say 30 bars back, has it been, we'll count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We'll say 30 bars back, has it been right? So now we need a new function, RSI above. Okay, and what this needs to do is this needs to look at our, we're gonna define a whole new set of code here, right? What we're gonna do is we're gonna say, for each RSI from RSI 0 to RSI 30 ago. Okay, we're just writing pseudocode. We're just making it up as we go along. And what we're going to do is, this is going to say, I'm going to look back at all of the previous RSI from 0 to 30, from then until now. And I'm going to make my RSI, and I'm going to say if, same way I did this here, if RSI is greater we're going to pass in the amount. So what we're going to say is we're going to take in an amount, and we're going to compare this to our RSI. And if RSI is above, because this is RSI above, we're going to say if the RSI is above the amount, what we want to do is we want to say that this is true. Okay? So what's going to happen is we're going to look at all of our previous RSIs, and if any of the previous RSIs were above 70, then this will be true. Otherwise, if that never happens, if that never occurs, then this will fall out of here, and we'll go return false. Okay? And in this way, we can define our function about RSI simply by looking at the RSI. Okay? Now we need to compute the RSI. Well, again, we already know how to compute the RSI. We can go back to our spreadsheet and figure out what it is that our spreadsheet tells us. And now we can write the code to do the RSI computation. Okay? Of course, I'm not actually expecting you to do any of this, right? These are how strategies are made. You take this idea right here. You take this concept, you take this strategy, and you break it down like this. Starting like this, then like this, then like this, and this goes together, but then you got to break this down further, which requires you to write this code, and then you got to break this down further, which requires you to compute the RSI from the price information. Then you got to do it again for the MACD. You got to compute the MACD from the price information, and you got to write this code. And fortunately, I can promise you somebody's already written this code for you, and later I'll show you how to leverage that. But right now, what I want you to focus on is the mindset. The mindset is that we go and we create our strategy. And then do we just turn the strategy on and hope that it works for us? No. We go here and we see if this is a good strategy for this market. We trade it on paper. We say, okay, RSI above 70. Has it gone back to 30 yet? No. Time to sell yet? No. Are we at the support resistance line? No, we're at the support line. Not time to sell yet. Going up? Not there yet. Not there yet. Not there yet. Finally, we are at the resistance line. It is time to sell. According to our strategy, it is time to sell. Finally, the MACD has signaled. All the stars align, and we sell. By becoming disciplined to a strategy that you have sat here and relentlessly made work for you in the market, and then applying on top of that a plan for profitability that will keep you profitable no matter what happens with this strategy. Well, we're not just going to go blindly trade the strategy. We're going to sit here and plan the strategy. Well, if you don't have automation, can you do this yourself? Of course you can do this yourself. Am I going to do it on a 1 hour time frame? No. I'm going to come here and I'm going to do it on a 1 week time frame. And suddenly this becomes a whole lot easier. Look at this, right? Suddenly it's not so hard to manage. If I were to do this once a week, could I execute my strategy here back in November and then get out of it here in February? Yeah. And make a lot of money that way using the strategy that you tested. Could you have done it here in October and look for an exit in 2018? Yeah. Absolutely. If you don't have a computer that's going to sit here and do it for you, well, don't be a computer that's going to sit here and do it for you. Do it on the schedule that works. If you have 15 minutes a day to come in here and automate your system, plan your trade, trade your plan. Okay? Here's your plan. Plan is we're going to do this, and we're going to do it with this amount. Starting at the bottom of the market, we're going to work out how much we're going to allocate for this opportunity. We're going to plan all the way up. We are going to use a strategy that has that plan executing only when that strategy is going to make us most profitable. We are going to use indicators. We are going to make signals like the news, like the MACD crossing, like the RSI moving, like the Williams indicator signaling green to signal the bottom, like whatever indicator you love, bring it on in here. Bollinger Bands, the works, right? You're going to go on Investopedia and Wikipedia and investigate what those mean, investigate what the hell these lines are. How are these lines drawn? What's going on here? Why are they moving this way? Why is this thing going up when the market's going, is just moving sideways? What's happening here? Why is this going up when the market's going down? Up, down, doesn't make sense. Investigate. Go look it up. Go Google it. Go find out how to apply these things, right? Make a strategy and see how that strategy tests in this market. See how you can make your strategy more profitable. But don't ever forget the plan. If you don't have a plan, well, you're just, shooting arrows, which is a fine strategy if you want to kill something. Make sure that you have a plan for a target you actually want to shoot. That's the most important part of all of this. I don't expect you to actually go and do this. I expect you to understand that this is what we must do in order to build this, 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 in order to do this, in order to do this, in order to do this, and make ourselves incredibly profitable all the time, no matter what, any way the market goes. You always plan the trade and trade the plan. And that is the way of the trader. Thank you very much.